There was an article recently in Atlantic Monthly, the magazine, entitled "The Looming Bank Collapse." It's by Frank Partnoy, and it's addressing an issue that didn't get a lot of headlines during the bank earnings last week, but it has to do with collateralized loan obligations and the fact that there are more than $1 trillion worth of leveraged loans currently outstanding, which are now grouped into these CLOs. Somebody who's been warning about this for a long time is Sheila Bair. She is not only the former FDIC chair, but she's the Volcker Alliance Director, and she's joining us now to discuss this potential problem going forward. Because, Sheila, one of the things that's pointed out in the article is that banks don't actually disclose publicly which CLOs they hold, and in some cases, they might place them into what's called a variable interest entity, which lack disclosure of the debt liability. This is a problem, right?
Yeah, well, no, that's absolutely right. Transparency is a problem, and a lot of this is reminiscent of some of the games that were being played during the great financial crisis. We called them civs back then, but the transparency could be a lot better. It's not just CLOs. There's some direct exposure to the underlying leverage loans as well. And so I do think, the FSB has done a lot of work on this. The Office of Financial Research has as well. The numbers, the numbers that we do have are pretty significant in terms of the percentage of total bank capital that these exposures represent. So it is something that does pose a risk to the financial system, the banking system in particular. It could very well come back onto the banks, even though there are others who are saying, the banks are insulated from this, they're not. And again, one of the many reasons why I've been saying banks should be suspending dividends right now, because it's a key area and example of losses coming home to rest on their balance sheets that they're not adequately addressing right now.
As an average investor like myself, when this article points out that there are institutions, and the article actually names Bank of California and Stifel Financial as having CLOs that total more than 100% of their capital. So if the leveraged loan market starts to implode, and in fact, we're seeing, for instance, AMC, which is one of these types of borrowers, may be in a default situation going forward. If it starts to implode, those liabilities become greater than the assets of the banks. That I don't know how to make heads of that.
Well, it could be, and I'm surprised by that because bank examiners generally don't like to see that. But setting that issue aside, these things are the banks will tell you, well, we hold the highest rated tranche of these CLOs, and that's what they said about subprime mortgage securitizations and CDOs as well. And the thing is, when you make loans to these weak borrowers who already have a lot of leverage, when you get into a severe economic situation, they can and do go bad all at once, right? So the assumption is with the higher rated tranche, well, so many others are going to have to default first before it reaches me. But what we saw with the subprime mortgages is they did all go bad at once, and it did reach those top rated tranches. So it's something. We should not be sanguine about that just because they're top rated. Doesn't mean they're going to be safe and they're going to be protected from losses. And again, this gets to another problem we had during the crisis that we never solved, which is the rating agencies and how they're compensated and their incentives to perhaps not always be as robust as they should be in rating these types of risky investments. So I think, I applaud Partnoy for writing it. I think it's exactly why a lot of us are saying banks should be conserving capital right now, not paying dividends, because it is a significant risk. Kind of the good news and bad news on leveraged loans is that for the borrowers, for the companies that are highly leveraged, these loans are covenant light. So there's going to be a lot of ability to negotiate, restructure. They can discharge this debt in bankruptcy. With mortgages, you could not do that. So from the borrower's perspective, it's not going to be as bad as it was for homeowners who got caught in these subprime mortgages. But for investors, the losses could be quite substantial because of those very few protections for investors. So I hope, I wrote over a year ago, Adam, as you know, because I think we talked about it, a piece for Yahoo Finance on this. And one of the things I said that regulators should be doing then is, get ready, make sure there's a workout strategy, the ability to restructure these loans, keep these businesses operational, which will avoid wholesale layoffs, which we don't want to see as the economy is already suffering so badly. But they need to be prepared because a lot of this, it's going bad now, and more of it's going to go bad.
Sheila, put this in a little more perspective for us. Compare this with the financial crisis. Level of concern versus then, level of threat versus then.
Yeah. So it's difficult. It's kind of apples and oranges because their banks were, as we've all acknowledged, are much better capitalized now. Hopefully, are taking fewer risks. But I think that the immediate severity of the pandemic is more substantial than we had during the Great Financial Crisis, where once we got the financial system stabilized, then it took a bit longer for the economic damage of all these loans defaulting to flow through to the real economy. So there was, it wasn't quite as sudden as I think this has the potential for being. I think the uncertainty is just the thing that's the worst. This is really, in modern history, we've never dealt with a situation like this. And even companies, we've all talked about leveraged loans, but corporate debt generally is at historic highs. A lot of companies were far too levered going into this crisis. And we could go into a very deep recession. We just don't know at this point. And so even the companies that are not highly leveraged could be facing substantial difficulties depending on how protracted the recession may become. So I think the key problem here is the unprecedented nature of what we're dealing with, the lack of uncertainty. Banks, yes, have more capital, but they also have significant risk. And so I think you've got to be conservative, given the uncertainty. Better safe than sorry. Conserve capital. Perhaps some banks should be raising capital right now. I applaud PNC for selling their share in BlackRock and raising a lot of capital on that basis. I think if the economy continues to deteriorate next year and we see other banks in trouble, PNC is probably going to be looking pretty good because they've been taking those types of prophylactic steps. I wish other banks were doing the same thing.
Sheila Bair is the Volcker Alliance Director and always welcome here at Yahoo Finance. All the best to you, Sheila. Thank you for joining us.
Thanks for having me. You bet.